And here he is, Mike Sigal. Welcome on stage, Mike.
Hi, everybody. Is that the right clicker?
Stage is yours.
All right, thanks so much. Excited to be here. Thank you very much for welcoming me. First time in Slovenia. So I've been learning a lot, meeting some really great people, and hopefully now I can bring you some perspectives that can help this market along. So let's start by making sure. There we go. What I mean when I say the word fintech. Basically, it's technology or brands that are changing the cost of delivering financial services. So I don't want anyone who's from insurance in the audience to think I'm not talking about them. And if anyone's selling AI or something into banks or insurers, I'm talking about you too. This is what fintech is. Everyone clear? So my own background, I'm a general partner at 500 startups running the fintech fund. I'm also a co-founder of something called Upside Partners. I'm a 6-time entrepreneur with a couple of exits under my belt. And I created something early in the days of fintech called the Untitled Challenges for an organization called SWIFT, which is a consortium of about 10,000 banks. And over the last 8 years, those challenges have facilitated about $1 billion in investments, acquisitions, and partnerships between fintech startups and banks. As so 500 startups, we're actually the most active early-stage fintech investor in the world. We have over 230 now portfolio companies in 26 countries, and folks like Credit Karma and Grab and Stripe, which are unicorns in the space, were some of our early investments. So we kind of know what's going on globally in early-stage fintech. Wearing my hat for Upside Partners, I counsel banks and insurers how to become more innovative, how to avoid disruption, how to change their cultures. So I thought I would start by giving you a little bit of a perspective of the roots of fintech. Where did it come from? Tim Berners-Lee, HTTP in 1990. This actually was first. You don't necessarily connect it, but I'm going to come back to this. But you're all aware of this. You may also be aware that the first over-the-top message went over mobile in 1992. What these two things did was they dragged millions of amazing entrepreneurs into the market to start questioning business models of incumbents. Things like media and retail and travel. The list goes on and on. In '94, this guy realized that something interesting was going on and made a prediction to say that banking is necessary, but banks aren't. Then in '97, Amazon patented one-click purchase. So what did that really do? That meant there was commerce with no evidence of financial services providers in the middle. This began to put financial services back where it belonged, which is under the view of customers. And then these guys came to the scene. Do you recognize the guy on the right there, Elon Musk? Well, he was involved in PayPal. And what this basically said was, we need to make payments easier in this new world of HTTP. Easier than banks were currently making it. Then you had these guys who did something really interesting. What they did was they provide global telecommunication services without having a telco. And then come 2007, Safaricom, which was the teleco carrier in Africa, set up essentially a non-cash trading service to bank the millions of underbanked consumers in Africa, right? you were able to essentially have a store of value in the form of minutes on your phone that you could use for buying and selling and later for borrowing. So here is banking without a bank. Now, interestingly, in roughly, I think it was 2012, the 4 banks that had licenses to trade in Kenya at the time, they went to the regulator and said, these guys are banking. Now, the answer was from the regulator, great, you've done nothing for financial inclusion in all the time that you've been here, and they gave Safaricom a banking license. And then 2008 hit. And all of a sudden, entrepreneurs began to think. So I want to share with you what they began to think. Where everyone else, right, banks and insurance firms and whatever was burning, entrepreneurs saw opportunity. They saw $13 trillion, 17% of global GDP. One of the, depending on the year, the biggest or second biggest industry on the planet, that had been untouched, really, by digital technology. At that point in time in the US, less than 1% of all loans were originated online. They saw an industry where 30% of OpEx was going to just keeping the wheels on the wagon, remediating technology, or legacy technology, dealing with regulation. So think about this in context. Citibank has about 400,000 employees worldwide. That's 130,000 or so employees who are doing nothing to add revenue. There are 3 billion new customers coming into the market that financial services, existing business models, are unable to serve. And they saw that these brands were defining what customer experiences should be like for financial services. Right? You expect your financial services to work as easily as everything else on this device. And interestingly, it's not just about consumers, because remember, inside large companies which are customers of banks and insurers, those individuals, they also want the experiences to be that easy. So financial services vendors lost control of what customer experiences should look like. And then there's this little issue. 71% of millennials would rather go to the dentist than go into a bank. And it's not so much about financial institutions losing millennials as customers. It's about the fact that the best millennials, the coders, the engineers, the data scientists, they'd rather work for Google than go to work for a bank. That's a big problem going forward. And then there was this little introduction, Bitcoin. So think about what happened when you had HTTP and OTP and voice over IP, what happened to various industries. It dragged great entrepreneurs and engineers in to question the underpinnings of the business model. I don't really care about Bitcoin as a currency, and I don't care about it as a store of value. I care about it as a motivating factor for brilliant people to come in and question the fundamental business models of financial services. So entrepreneurs and engineers began doing just that, questioning the business models of financial services across the entire spectrum. Banking, payments, wealth management, investment banking, insurance, all of it. And then the VCs figured it out. And they started pouring money after those companies that could either disrupt or enable the disruption of financial services. Fastest growth of venture capital of all time. And as of 2015, 15,000 new startups picking apart every aspect of financial services. And these are only the venture-funded ones. And that market started to generate real returns. 26 unicorns. Interestingly, none of these are actually disrupting banks or insurers. Yet they've gotten to this scale. Here's another interesting thing. Are any of you old enough to remember when there was going to be a Silicon Valley of Central Eastern Europe or a Silicon Valley of France or whatever. None of those ever worked because Silicon Valley has history and density. But something really interesting has happened with financial services because there are banks and there are brilliant engineers all over the world. So governments are partnering with industry to create innovation economies around financial services. 68 of them today. And investment hasn't slowed at all 10 years later. So when you get to the question of what's going on in financial services with regards to disruption, is it really disrupting the way things have been working? Well, this is Jamie Dimon, CEO of JP Morgan Chase, and in 2015, he recognized that entrepreneurs and engineers are coming after financial services. This is one of the reasons why he recognized it. Look at that difference in performance, top 10 banks versus top 10 fintechs. That's danger. Our friends from PwC did some research a little while back to figure out what was actually going on. And like so many industries before that have been touched by digital technology, it's a question of margin compression. The profits are being taken out of the industry. Players have to work harder to earn their place. That's potentially a really big loss. And according to the World Economic Forum just last year, what fintech has actually done is change the terms of competition in the industry. It hasn't said that fintechs are going to win, or banks are going to win, or telcos are going to win, or that Amazon and Alibaba are going to win, but now everyone is competing to provide great financial services. Now, I want to talk about Uber for a moment, right? Did anyone see that Uber launched a credit card? Or does anyone know that Uber actually went into the car loan business? So something really interesting about that. They never wanted to be a financial services provider. They were happy to lose money on giving car loans as long as it won them and retained them drivers faster than Lyft. They play a different game. So now you think about Amazon, there's a question of, will companies like Amazon go into financial services? Could you imagine wanting to be a regulated financial services company? Not so much. On the other hand, Amazon wants to drive its growth. And if financial services introduces friction into Amazon's business, they're going to run around it. So when you look at the industries that have come before and gone through digital disruption, right, you see that there are a mix, and this is top revenue earners in these industries globally in 2017. There's a mix of new entrants and incumbents who invested heavily in becoming more innovative and more agile. These guys. So I submit to you that whether you're going to be disrupted if you're a large company is your choice, because you can see from past industries and patterns that innovation happens or disruption happens predictably, and the question becomes, are you going to get ahead of it or are you going to let it run over you? And it's very difficult to do, but it is possible. So JP Morgan has been investing heavily in going after becoming more agile, becoming more technology friendly. We've got a long ways to go, but they're working on it. Now, an example of someone who's done really well in this industry so far is Goldman Sachs. Goldman Sachs, the first time I met a Goldman Sachs venture capitalist was in 2007. They were investing directly into companies at that point in time. Last year, they launched something called Marcus. Now, Goldman Sachs is an investment bank, right? They don't do consumer lending. Marcus is a consumer lending business that lends individuals somewhere between $15,000 and $35,000. They did $2 billion of originations in their first year, blowing past all top online lenders combined. And it's because they had invested since 2007 in becoming more agile, more technology friendly. So if you look across venture investment globally into fintech, roughly 30% of it comes from banks and insurers that are trying to figure out their future. And they're getting more and more acquisitive. And I think what we're going to see, which is sort of different than many other industries, right? In many industries, you get a new entrant that becomes dominant relatively rapidly and puts everyone else to shame. In financial services, because it's controlled ultimately by regulators, right? You're not going to see one company to dominate globally. You're going to see lots of them. But most large institutions are very slow to adapt, and they're going to have to practice something that we call the unicorn hedge, which is they're going to have to buy their way into the future, right? Think about Walmart buying Jet.com for $3 billion, or Unilever buying Dollar Shave Club for $1 billion. So I think there's going to be a ton of amazing exits in financial services, maybe more than most other industries combined, simply because there are so many banks and insurers around the world who are protected by regulation, but they're going to be competing with each other to see who can be more innovative faster. All right, so now let's talk about the future, and I like to think about, is something hot or is something not? And generally speaking, as an early stage investor, I follow the money because I'm always worried whether my investment is going to be able to raise the next round of capital. So starting with hot, helping banks or helping banks' customers become more innovative more quickly is a really good business to be in. One of my favorite areas is something that I call CFO tech. If you think about it, broadly speaking, the sales office in enterprises and the marketing function in enterprises, they've all gotten really cool tools in the last 10 years. The poor CFO is still stuck with Excel, right? So we invested in a company not too long ago called YayPay. They accelerate cash collection after sale. They sell directly to enterprises and medium-sized enterprises. We invested in them. We put 150 grand into them. 9 months later, they raised $5.3 million as a seed round in partnership with a couple of banks, because the banks realized they needed to serve their enterprise customers more effectively. Blockchain investments have finally turned around, right? We saw over the last couple of years, there was a ton of blockchain proof of concepts and no action. Those proof of concepts are beginning to bear some fruit, and so now investors have gotten interested in blockchain again. And this has nothing to do with crypto. Capital markets, right? How banking and investment banking work. Now, the other thing that's interesting about crypto, given its growth, is you can pretty much bet that it's going to be an ongoing feature of how economies work. Well, you think about all those giant banks out there, they know how to deal with dollars and euros and all of that, but they don't know how to deal with, they can't count, they can't market around, they can't measure, they can't do analysis around cryptocurrencies, but they need to. So this is a huge thing. And I think this week at Consensus, you're going to hear a couple of really big banks announce that they're offering custodial services so that the trillions of dollars of wealth that hasn't touched crypto yet can trade in crypto. That 30% of OPEX that is spent by banks and insurers to deal with regulation, interesting new technologies can help those banks bring down the cost of complying with regulation. Wealth management went through a problem that those early low numbers, that's because a ton of money on the order of $500 or $600 million of venture investment went into things like Betterment and Wealthfront and Nutmeg in the UK and bore no fruit yet. But when you think about now taking technology and enabling Fidelity or Credit Suisse or whoever it is to make them more efficient, there's an interesting business there. And insurance keeps on growing. Insurance is probably 5 to 6 years behind banking, and they're on a much higher ramp in terms of using new technology. It's also really interesting. Banking sort of exists as this stack with deposits at the top and loan production at the bottom, and you can't really disrupt it. But insurance is strung out, and insurance touches the real world. So IoT plays into insurance innovation. We've got a company called Kin that provides home insurance. Now, part of what they do is just make buying home insurance a 15-minute process instead of a 5-day or 5-week process. But they sell right now catastrophe insurance to homeowners. So in Texas and in Florida, if there's going to be a hurricane, right, that's what you need catastrophe insurance for. So there was a hurricane since they launched. And they partnered up with one of our other companies that flies drones around. Right? And what did they do after that hurricane hit? They flew a drone over every single one of their customers' homes, and they sent a text that said either, your home's okay, don't worry about it, or your roof is toast, we've already started the claims process. That's kind of cool. Okay, so what's not hot? Trying to win consumers one at a time. It's really expensive, it's really hard, and at an early stage you're going to have a really difficult time showing that you have the unit economics to justify your next investment. As an example, direct lending to consumers, especially when Goldman Sachs walks in with a $2 billion balance sheet and just nails it. ICOs is part of financial services. It's the one that attacks my business directly, right? If someone can go raise an ICO, why should they raise from a venture capitalist? Problem is, there's 70 to 100 ICOs a day, and 99.999% of them are bullshit, and everyone's figured it out. Because people who have the capital, who have made money in Bitcoin and made money in Ethereum, they're not idiots, and they don't invest in white papers. So I don't know if any of you will understand what this means. There's a show in the 70s in the US, right, called Happy Days, and it ran for a really long time, and when it got really tired, they had the main character jump a shark on water skis. And that means jumping the shark is when stuff is really tired. So if any of you here in the audience are going to try and raise an ICO, and you haven't built technology, and you haven't gotten any customers yet, go get a job. Anytime?
Personal note, True 500 style. I always kind of like that.
What's that?
True 500 style is always good subtext. I enjoyed myself. Jumping the shark. Yes, I like that. And I think the leather jacket makes all the difference.
It really does.
Yes,
it really does.
That's doing things.
He's got better legs than me, too.
That's doing things in style. So we have a couple of questions here, and that's, in general, are established banks and insurances picking up speed in innovation, or is the gap widening?
Okay. Look, there's just SWIFT alone, right, which only deals with international banks. There's 10,000 banks. There is this giant spectrum about leaders and laggards, and everyone's somewhere along the spectrum. Most banks around the world have some idea, and this goes for insurers as well, that there is something going on. But that whole idea of there is a choice as to whether you're disrupted or not, different willingness to engage in the hard work that you have to do to change your culture, to change your talent. You can take a bank like BBVA, which is run by a software entrepreneur who got on stage at Mobile World Congress a couple of years ago, and he said, in 10 years, we're going to be a software company, and every bank that isn't a software company will be dead. I happen to agree with that.
Mm-hmm. And we have time for one more question, and that's all interesting one as well. Is GDPR a threat or an opportunity for banks?
Yes.
Thank you so much.
The only blockchain investment that I've done is one that helps with the GDPR problem. So, and I don't know that this is going to happen, but here's one way to think about it. It used to be that banks were actually the true source of trust. Depends on the market you're talking about, but that's certainly in the US, that's kind of been lost. You kind of got to wonder, though, can a bank be in a position to be the escrow of trust?
We'll find out.
Yeah. Anyway, thank you, everyone.
It's been a pleasure.